If you're a first-time buyer and you've got some questions about mortgages, then stay tuned for this. Hi, I'm Brad Wild from the Go Wild team, and I've got Anne-Marie here from TD. She's one of our mortgage specialists. And today we're just going to be going over some questions that a lot of first-time buyers have about mortgages. So the first one I wanted to ask you was, what is the quickest and best way for someone to find out what they can afford?
Best way, Brad, would be for them to reach out to their financial institutions, mortgage brokers, to get a pre-approval in place.
Yeah.
Questions will be asked of them regarding their income, their employment, to come up with a figure.
And is there kind of like a rule of thumb that you guys go off of for ratios for figuring out, what someone can afford, or how does that work?
For sure. Qualifying for a mortgage these days has become somewhat of a challenge with the new rules that the government has set out. There's two ratios that we look for when qualifying customers. That would be your total debt servicing ratio and your gross debt servicing ratio.
Yeah.
Total debt servicing ratio would include your principal, your interest, your taxes, and your heat.
Okay.
Gross debt servicing ratio includes principal, interest, taxes, heat, and all your outside debt, whether you have utilized it all or not.
So are there some specific ratios then that you guys go by to determine how much someone can afford?
For sure. The banks and mortgage brokers look for what we call debt servicing ratios. TDS is, in other words, total debt servicing ratio. What that includes is principal, interest, taxes, and heat.
Okay.
GDS, gross debt servicing ratio, includes principal, interest, taxes, heat, and all your outside debt, whether you utilize it or not.
And do they have to qualify for both of those ratios to get like the amount, or how does it work? Or is it just does one overrule the other? How does it?
No, so correct in the sense that they have to qualify under a certain percentage in order to obtain financing. 33.3% is the maximum total debt servicing ratio.
Okay.
44.4% is the total gross debt servicing ratio.
So basically like 44% of all of your income then. Okay.
Correct.
Okay, very interesting. And so with pre-approvals, like what's the difference between, you can go online, you can, type in these numbers and like, what your income is and stuff like that, and it'll give you kind of like an automatic pre-approval versus going and actually meeting with a broker and sitting down with them. Like what's kind of...
For sure. So we're seeing more and more in the digital world, online approvals being available for clients. They are helpful. They aren't as accurate as meeting face-to-face with somebody to get qualified. Biggest thing I find with those pre-approvals, they're not taking into account your credit rating. They're not taking into account what debts maybe you think you don't have but are appearing under the bureau that maybe...
Yeah, I've seen that before with other people,
It's not taking into account what your true actual income is. Meeting face-to-face, someone may think they make $40,000 a year, but actually they could be, not including benefits that they're getting through work. All of that can be added back.
You can add benefits?
Correct. You can add back, your car allowances and things like that. You may get bonuses throughout the year, all of that.
So you may actually be able to qualify for more by actually going in and meeting with a good broker.
Absolutely.
Than just what the automatic system tells you.
Absolutely.
Okay. And so for buying a house, what type of down payment does someone need? Like what's the minimum? What would you say is kind of the normal? And
so there's two mortgages available for consumers in the housing market. Conventional mortgage. What this means is you have 20% down payment available to put down on a home.
Okay, yeah.
Most first-time home buyers, unless you're very fortunate, don't have a 20% down payment, in which case you can qualify for 5%, anywhere between 5 and 15%.
Yep.
It's a different type of mortgage. It's called a high-ratio mortgage.
And then you have to pay an insurance premium on that.
Correct, through the Canadian Mortgage and Housing Corporation.
Okay, and how does that premium work then? Is it, do they pay it up front? Does it get, how does...
So how the CMHC premium works is you qualify for 5% down, up to as minimum 5%. The CMHC premium is then added to your mortgage on funding. So essentially, you're putting 5% down, but adding 4.5% down at closing.
Oh, okay. All right. So you're not paying it up front, just gets tacked onto your mortgage. So it'll be an extra, like,
That's correct.
15 or whatever dollars a month.
So we qualify you for the price of the home with the CMHC premium added back.
Oh, okay. Very interesting. Is there any difference between there's a couple different mortgage lending insurance companies, right? So there's CMHC, Genworth.
Yes,
Are
those are the two.
Okay.
Yeah, virtually they are the same.
Okay. Okay.
Yeah, depending on who you go to for your mortgage will depend on
who you pick.
Right.
Okay. So are there any incentives for first-time buyers or different things they can take advantage of when they're buying their first home?
So March of 2019, with the new budget, there was a couple of announcements made. What we do know at this time is in regards to the first-time home buyer RSP withdrawal. Limit has now increased from $25,000 to $35,000. Which this essentially means is prior to that, a first-time home buyer could withdraw up to $25,000 from their RSPs.
Okay.
That now has increased to $35,000, repayable over 15 years.
Okay, so they have 15 years to pay it back before they have to worry about taxes. Okay. Yeah.
Another incentive is your land transfer rebate. Any first-time home buyer can qualify up to $4,000.
That's actually a substantial cost, land transfer. It's amazing. A lot of buyers don't realize about that before closing it.
For sure.
It could be a nasty surprise for some people. Yeah,
for sure.
Yeah.
So I usually tell my clients factor about 1.5% of the purchase price for your closing costs. And that, of course, part of that is your land transfer, which will be rebated from the lawyer.
Yeah. And a lot of buyers, they don't know about that rebate. And if you don't ask for it, you don't get it.
Absolutely.
I know. Yeah, I didn't get it on my first one. So, yeah.
Another incentive that has recently been announced in March of 2019 is the loan that is going to be available for first-time home buyers. 5% for resale homes and 10% for new builds. My advice along that line would be to speak to your mortgage professional to get more details exactly on that.
Pretty complicated. So, yeah.
Yes.
So now, like with first-time buyers, what we're seeing with housing prices, it's getting harder and harder for them to qualify. And with the new mortgage rules, are there any creative things that people can do to help them qualify for a home right now?
Yes, you're absolutely correct. It's a very challenging time for first-time home buyers. There are creative ways. We're finding in the industry, a lot of first-time home buyers are needing to have a cosigner, a parent.
Does it have to be a family member for a cosigner, or how does that work?
It doesn't.
No? Okay.
It can be, anyone that's. We recommend family, especially if you're using the high ratio mortgage through CMHC. That is a requirement. They have to be, it just can't be your neighbor down the street.
Yeah.
Another creative way is, of course, gift letters. If you're fortunate enough to have someone in the family who would like to gift funds towards the purchase of your first home, the banks require a signing of a gift letter which verifies the funds on deposit.
And that's just proving that it's actually a gift and not another loan.
Correct. It has to be a gift, a true gift, in the sense that it is not to be repaid.
Okay.
Another creative way would be to, if you're self-employed, business for self, incorporated, there are ways to increase your income through add-backs that you're declaring on your T1 generals.
So what would like an add-back be?
So an add-back would be your vehicle expense, capital cost allowance, and business use of home office.
So one other thing, so once someone does have a pre-approval, before they actually go and buy a house or before they close on a house, what are some things that, maybe they shouldn't do or they should watch out for?
We see this time and time again. You certainly need to know the difference between a pre-qualified and a pre-approval. Pre-qualified simply means, like we said previously, what's a quick way to figure out what you can afford.
Okay.
That would be something that's pre-qualified. A pre-approval is actually, we have obtained your income. We've gone through your credit rating. We know what kind of a buyer you are.
Okay, so it's a lot more solid.
It's more solid. A pre-approval certainly is more solid than a pre-qualification. Okay. But we do see time and time again, a pre-approval does not give you full reign to go out and buy that new car next week or go out and go on that holiday you've always wanted to go on, because those numbers are going to certainly increase your debt capacity, which will therefore change your ratios when it comes time to purchase that home.
So the bank can still pull back that pre-approval, even though it's like, a 90-day or 120-day commitment.
Absolutely.
They still have the right to withdraw that at any point then?
Absolutely.
Okay.
With a pre-approval, we always need updated income. So you could get a pre-approval today, 6 months down the road, come back. We're going to ask for updated income, because in those 6 months, you could have lost your job. You could have got a raise. You could qualify for more. You could qualify for less.
Okay. Yeah.
So yes, a pre-approval does, although it's certainly peace of mind, it is not a guarantee.
Okay. And then, so the difference between a pre-approval and an approval then, is it approval like once you finally got that paperwork back and you've signed everything off, is that?
So a pre-approval is confirmation from the bank or financial institutions that you're dealing with that you could qualify for a home for X amount of dollars.
Okay.
An actual approval is the details of the home. We know when the closing date is. We know the price of that home. And that would be a firm approval.
And that's when it's done. Is there any way that the bank can pull back, like before closing, after you've gotten approval or a lender?
Once the approval is concrete, we now know where your down payment is coming from. That is all verified ahead of time. So not very often do we ever see a bank pull back on an approval, because we are not going to give you a firm approval until all the conditions are met.
Okay. And then actually, you said something the other, or a little back, that reminded me. So for people who have, especially first-time buyers, and a lot of them are fairly newly employed and stuff like that, what are the rules around income and for you guys being able to, use that income? Like I think is it 3 months they have to be working with the company, or how does
Correct.
that work, and with job changes and all that?
So in order to qualify for a mortgage, we do ask that a candidate be 3 months employed at the current employer. We will ask for verification of that in the form of a letter of employment stating that you are no longer on probation, and that your job is permanent.
Okay, so even like for someone who's on like a temporary contract, like with, for example, a lot of teachers and stuff like that, they get like a 1-year contract with with the school or whatever. So during that period, do they have trouble qualifying usually, or?
We don't find with contracts it's too difficult. We will ask just for a letter from the employer stating that that candidate.
Okay.
And if it makes sense, usually everything has a story, and if that story makes sense.
So it is kind of on a per scenario basis.
Absolutely.
Still. Okay. And then what about self-employed people? I know that's even more difficult.
It is.
Self-employed. Yeah.
So self-employed people, it is a bit more of a challenge.
Yeah.
We do need 3-month job tenure. So you can't go in to a bank, open a business account a month ago, say you're going to make X amount of dollars. The banks are going to ask for a history.
Yeah.
So it's a 3-year business for self policy that we have in place. So it just involves us being able to verify that you have been business for self for 3 years.
3 years, and you've got X amount of income. And
there's a history there.
Yeah. Do you just use an average over the 3 years to qualify?
We
income?
do. We use your average line 150.
Okay.
And then, as mentioned before, we can add back if we need to increase that income.
So when someone meets with a broker and they get a pre-approval, do you recommend they still put that financing condition in their offer?
For sure.
Yeah.
The finance condition, it protects you as the buyer. It protects your deposit that you put down on that home. It also gives you an out. If you get cold feet, if you find something in the meantime that's a little bit more affordable. But the biggest thing is it also allows the institutions to turn that pre-approval into a live deal. There could be issues where you pay too much for the home, and CMHC, the Canadian Mortgage and Housing Corporation, won't insure that home for the amount that you paid.
Yeah, we saw that a lot in 2017 when
all
the houses
values
were going to bidding wars. We're seeing people pay 150,000 over asking, and then the bank wouldn't lend them the full amount, so they're on the hook. Okay.
Absolutely. Yeah. And as first-time home buyers, it's important to know you also are at an advantage because you don't have a home that has to be sold. That is then usually the number one condition that we find. Sometimes it sometimes gives you an advantage.
Yeah. Awesome. Well, thank you so much, Anne-Marie. It was a lot of great information. I hope everybody found this useful.